When interest rates go up, bonds are going to get hammered. I've heard this so many times, man, so many times. And I see people right now, they email me all the time, and I get rightly so. They say, I'm worried about my bonds aren't doing anything, blah, blah, blah. Man, I tell you, this, I hear this a lot. Interest rates will go up, right? They have to. And on top of that, we've already talked about that, but they see interest rates have gone back up from their low of the beginning of the pandemic reaction, not the pandemic, the reaction to it. And people are like, oh my goodness, interest rates are on this death spiral up. We're all going to get killed in the bond market. We're just coming back to normalcy in this low interest rate environment we will forever live in. All right. So let's dive into this part 6 or part 5 of our bond masterclass using Alan Roth's 8 great misconceptions on bonds. All right. If interest rates shoot up, the bond bubble prediction will come true. I've been hearing about a bond bubble for a long time, says Alan. Let's frame what could happen if bond rates surge, as I found it gives clients some comfort. The illustration below, and I'll link again the show notes so you can click on it yourself, because it's going to be hard to see. Well, actually, what if I click on it? We'll jump out. Yeah, not really. All right, so the illustration below is based on a fund like the Vanguard Total Bond Index, BND, which has a 6.3% duration and a 1.44% yield. Taking a 4 percentage point increase in rates over 1 year, 4 percentage point, the bond would lose an estimated 21.7% in 1 year's net asset value, the value. So if you had $100,000 in there, not including interest rates, and the interest rates went up by 4%, you would lose $21,760. Well, you'd be down that. You don't lose it, you'd be down. But that's barely more than the stock market lost on Black Monday in 1987. In fact, the stock market lost over 11% on March 16th of last year, in just one day. Never mind 21% in the bonds. Back to the total bond fund example. If rates then stabilize, the fund manager is now buying bonds yielding an average of 4 percentage points higher. By year 6, the loss is wiped out, and by year 8, the gain is higher than it would be if the rates had not risen in the first place. All right, so basically what's happening is you're getting a higher rate of return with coupons being 4% higher, which will obviously come back to give you that money back you quote lost. I actually want to show. So let me explain this a little bit because this is actually pretty important. All right, so the rates, if they go up 4% one given year, yeah, you're going to be down 20%. All right, do you think the stocks are exempt from that too, though? Remember, there's always something called don't fight the Fed. You fight the Fed, you can't fight the Fed. All right, and so if rates go up on bonds, stocks are immune from that? No, man, stocks get hammered too, man. Why do you think the stocks were the price earnings ratios on the stocks were so low in 1982? Because the rates are so high. Because inherently what happens is you have so this is the thing I hate about duration. People don't live in a bubble, so they see the interest rates going up. They don't sit there and just idle time. They say, okay, well now bonds are worth more now because the rates are higher than what they were a year ago when the rates are lower. All right, so what does that mean? Now my stocks aren't paying as much dividends relative to the bond interest rate I'm getting. So, and on top of that, my stocks have no guaranteed coupon. They have no guaranteed maturity date. So my bonds become a whole lot more attractive because the rates are higher. So that would say to people that I'm going to start selling my stocks and investing in my bonds because the rates are higher. So in a pure mathematical academic exercise, we could say it takes 6 years because the duration of whatever it was, 6%, it takes 6 years to make that back up. But in reality is that people are going to be flocking more to bonds because the rates are higher, which means the price it doesn't just sit there in a vacuum, man. It doesn't just say it's $71. $79. So if we had $100 NAV, net asset value, price per share of a bond, it doesn't go to 79 and just sit there until maturity. There is these things called the market, and the market says, so now I'm getting 3-4% more than I was getting on a bond. That's a whole lot more attractive. Let me go buy those bonds up, if that makes sense. And then the NAV just goes back higher before the matures. This isn't a vacuum, man. It's not an academic exercise. It's reality. In stocks, I'm just telling you, don't fight the Fed. When the interest rates go up, people say that's when the stocks will go down. I'm just telling you. All right, so part 2 of this. Let me hold on just a second. Here's a Vanguard Total Bond Market Fund. So to alleviate concerns of the bond market just getting hammered and we're all going to lose our shirts, let's just go back to history. So we're going to remember, so the Fed was raising in 94, 99. So we know those 2 years right out of the gate, 94, 99. So let's go back to the total bond index fund. The Fed was raising, so it fell 2.66%. The Vanguard total bond index fund. The following year is up 18%. 99, the Fed was raising. It fell less than 100 basis points, less than 1%. The following year is up 11.39. Let's go back. It started in 87. So we have in 1990 was, well, I guess the bonds did actually okay in 1990. 2008, where everything else was getting crushed except for government bonds. Remember, the predominant holding in the government bond, the total bond index, is 70% government bonds. It did just fine. 2013 was down 2.2%. It did just fine the following year. And then in 2018 it was down that. It did fine the following year. I cannot guarantee you or assure you that will happen again. Show me any history of a bond index that has had consecutive down years, though. I mean, I don't know any. I'd like to see it, frankly, but that's the exception, not the rule. And the idea that even if we have the idea we have a 4% increase in interest rates is blatantly absurd, for sure. The Fed is not going to raise interest rates by 4%. And as such, the market, which is the longer term bonds, are not going up by 4% anytime soon. It's just not. I mean, it could happen, I guess. And then I bet the following year, the bond index will tear off. It will take off like a bat out of hell just because they're saying, wow, I'm getting 4% more on my coupons I was getting. That's a very attractive relative to a stock. Yeah. So anyway, hope that helps. We'll see you.